Most traders believe profitability comes from finding the perfect strategy. They search endlessly, new indicators, better entries, smarter exits, believing that if they could just discover the right method, discipline would naturally follow. But that belief is backwards. Discipline does not come after success. Discipline is what creates success, often in spite of the strategy itself. The market does not reward intelligence. It does not care how complex your system is or how confident you feel about your analysis. The market only responds to behavior, and behavior is controlled by discipline. This is the uncomfortable truth. Most traders resist. A mediocre strategy executed with flawless discipline will outperform a brilliant strategy executed inconsistently. This speech is not about improving your strategy. It's about understanding why. Discipline has the power to transform even flawed methods into profitable outcomes, and why without it, no strategy will ever save you. The market is an environment of unlimited opportunity and unlimited uncertainty. Every moment presents a possibility, but no moment offers a guarantee. Most traders enter this environment believing their job is to predict, to know what will happen next. But profitability does not come from prediction, it comes from alignment. Alignment between what you believe, how you behave, and how the market actually works. A bad strategy is rarely the real problem. What traders call a bad strategy is often just a strategy that produces random outcomes in the short term, which is exactly how all strategies behave. The difference between profitability and failure is not the quality of the method, but the trader's ability to execute it without interference. Discipline is not about forcing yourself to follow rules. That definition alone guarantees failure. If discipline requires effort, it means there is internal conflict. And where there is conflict, fear is present. Fear of losing, fear of being wrong, fear of missing out, fear of giving back profits. These fears are what sabotage execution, not the strategy itself. Consider this: even the most basic trading method applied over a large enough sample size with consistent risk will reveal its edge, if one exists. But most traders never reach that sample size. They interrupt it, they hesitate, they skip trades, they exit early, they move stops, they double risk. Each emotional decision breaks the statistical foundation that makes profitability possible. Discipline allows probability to function. A bad strategy executed with discipline still produces data. It still produces consistency. It still allows the trader to observe outcomes without distortion. An undisciplined trader never sees the truth of their system, only the emotional chaos they inject into it. The market does not punish bad strategies. It punishes inconsistent behavior. Discipline means you take the trade even when it feels uncomfortable. You take the loss without justification. You take the next trade without emotional residue. You do not negotiate with uncertainty, you accept it. When uncertainty is fully accepted, fear disappears. And when fear disappears, discipline becomes natural. This is the paradox. Discipline feels difficult only when you are emotionally attached to outcomes. The moment you stop needing the market to validate you, discipline stops being a struggle and becomes a state of mind. Most traders sabotage themselves because they believe discipline is about control. Control over emotions, control over impulses, control over outcomes. But discipline is not control, it is surrender. Surrender to randomness, surrender to not knowing, surrender to the fact that no single trade matters. A disciplined trader understands that their job is not to win, their job is to execute. Winning is simply a byproduct of consistent execution over time. Bad strategies become profitable when discipline removes emotional interference, because emotion is what converts small statistical edges into large losses. Emotion is what turns normal drawdowns into catastrophic decisions. Emotion is what convinces traders to abandon systems right before they would have worked. When discipline is present, losses lose their meaning. A loss becomes information, not a verdict. A win becomes confirmation of process, not proof of intelligence. This emotional neutrality is what allows traders to stay in the game long enough for probability to work. Discipline also creates trust. Trust in yourself. And self-trust is the most valuable asset a trader can possess. Without it, every decision feels dangerous. With it, uncertainty becomes manageable. A disciplined trader does not need confidence in the market. They only need confidence in their ability to follow rules. That confidence alone stabilizes behavior, reduces impulsive actions, and allows even imperfect strategies to perform. The irony is that most traders search for better strategies when what they actually need is better discipline. And until that shift occurs, no system will ever be good enough. Discipline removes the emotional noise that distorts perception. It allows traders to see the market as it is, not as they want it to be. And when perception is clear, execution becomes effortless. The market rewards those who can behave consistently in an inconsistent environment. That is the defining trait of successful traders, not intelligence, not intuition, not prediction. Discipline creates an edge even when the strategy is imperfect because the market does not reward ideas, it rewards behavior. Most traders misunderstand where their real advantage comes from. They believe edge is something hidden inside indicators, entries, confirmations, or secret techniques. They assume that if a strategy is not perfect, it cannot work. But perfection has never been the requirement for profitability. Consistency has. An imperfect strategy is not a weakness in trading, it is the natural condition of trading. Every strategy operates in an environment of uncertainty, where outcomes are distributed randomly in the short term. No method can eliminate that randomness. The moment a trader expects certainty from a strategy, they begin to interfere with it emotionally. That interference is what destroys the edge, not the flaws in the method itself. Discipline allows a trader to participate in the market without trying to control it. When discipline is present, the trader no longer reacts to individual outcomes. Each trade becomes just one event in a long series of events. This perspective is critical because probability only reveals itself over a series, never in a single moment. An imperfect strategy can still have a positive expectancy, but that expectancy only materializes when the trader executes the same behavior again and again without deviation. Most traders never experience the true performance of their strategy because they never trade it the same way twice. They hesitate after a loss. They overcommit after a win. They skip valid setups because of fear. They add risk because of excitement. Every emotional adjustment changes the statistical profile of the system. What they end up trading is not a strategy, it is a collection of emotional reactions. Discipline removes those reactions. It does not remove losses, but it removes the meaning attached to them. A disciplined trader understands that losses are a natural cost of participation, not a signal of failure. This understanding changes everything. When a loss no longer threatens identity, confidence, or self-worth, the trader stops fighting the market. They stop trying to avoid pain. And when pain is no longer avoided, discipline becomes effortless. An edge is not about being right. It is about behaving consistently when you are wrong. Every profitable trader experiences losses. The difference is that disciplined traders do not allow losses to alter their behavior. They do not try to get revenge. They do not try to recover quickly. They simply execute the next trade according to plan. That is how an edge survives. An imperfect strategy may have periods of drawdown, inconsistency, or frustration. Without discipline, these periods feel unbearable. The trader starts questioning everything. They abandon the method. They search for something better. In reality, they are running from uncertainty, not from a bad strategy. Discipline allows the trader to stay present during uncomfortable periods without making changes driven by emotion. This staying power is what most traders lack. The market does not require brilliance. It requires emotional neutrality. Discipline creates that neutrality. It places the trader in a mental state where no single outcome has power. When outcomes lose power, the trader stops making impulsive decisions. And when impulsive decisions stop, even a simple perfect strategy begins to perform as intended. Many traders believe discipline means forcing themselves to follow rules. That belief makes discipline feel exhausting. True discipline does not come from force, it comes from acceptance. Acceptance of risk, acceptance of uncertainty, acceptance that losses are inevitable. When these facts are fully accepted, there is nothing left to resist. And when there is no resistance, discipline becomes natural behavior. An imperfect strategy executed with discipline produces clean data. Clean data leads to clarity. Clarity leads to confidence. Confidence leads to consistency. This sequence is impossible without discipline. Undisciplined traders never see reality clearly because their emotions distort their perception. They remember losses more vividly than wins. They exaggerate drawdowns. They minimize progress. Discipline stabilizes perception so the trader can evaluate performance objectively. Discipline also creates trust in the process and trust in oneself. Self-trust is not built by winning trades, it is built by following rules regardless of outcomes. Each time a trader executes correctly despite fear or doubt, they reinforce a powerful belief: I can rely on myself. That belief is the foundation of long-term success. Without it, every decision feels fragile. A bad strategy becomes truly bad only when discipline is absent. Without discipline, risk expands unpredictably. Losses cluster. Emotions escalate. The trader abandons NS structure and enters survival mode. In that state, even the best strategy will fail. With discipline, risk remains controlled, behavior remains stable, and the trader remains mentally present. That stability alone creates an advantage over the vast majority of participants. The market is designed to exploit emotional inconsistency. It rewards those who can remain consistent in an inconsistent environment. Discipline is the mechanism that makes this possible. It allows the trader to operate independently of fear and hope. Hope makes traders hold losers too long. Fear makes them exit winners too early. Discipline neutralizes both. An imperfect strategy does not need to be improved before it can be profitable. It needs to be executed without interference. Most traders try to improve their strategy to avoid emotional discomfort. They believe better logic will reduce fear. But fear does not come from the market. It comes from beliefs about the market. Until those beliefs change, no strategy will ever feel safe. Discipline shifts the trader's focus from outcome to execution. Execution is controllable. Outcome is not. This shift is critical. When the trader defines success as flawless execution rather than profit, emotional pressure disappears. And when pressure disappears, performance improves naturally. The edge created by discipline is invisible but powerful. It does not show up on charts. It does not come from indicators. It shows up in behavior during drawdowns. It shows up in the ability to take the next trade without hesitation. It shows up in the willingness to accept losses without emotional disturbance. That is where most traders fail. An imperfect strategy, applied with discipline over time, reveals its true expectancy. If the expectancy is positive, discipline allows it to compound. If it is negative, discipline allows the trader to recognize that fact objectively and make adjustments without emotional bias. Either way, discipline accelerates learning and progress. The trader who lacks discipline is always starting over. New system, new rules, new hope. The disciplined trader stays long enough to let probability work. That alone creates separation from the crowd. Discipline does not guarantee success, but without it, failure is guaranteed. It is the filter that determines whether a trader ever reaches consistency. It transforms trading from emotional gambling into professional execution. And in that transformation, even imperfect strategies find room to succeed. Undisciplined traders turn good strategies into losing ones, not because the strategy stops working, but because their behavior destroys the conditions under which the strategy can work. The market does not sabotage traders. It simply reflects back their inability to remain consistent in an environment of uncertainty. A good strategy only has power when it is executed as designed. The moment execution becomes emotional, the strategy no longer exists in its original form. Very strategy is built on assumptions about risk, probability, frequency, and time. These assumptions only hold true when the trader follows the rules exactly. Undisciplined behavior breaks those assumptions trade by trade, skipping entries, moving stops, increasing position size, exiting early, or hesitating after losses, all change the mathematical profile of the system. What was once a positive expectancy method becomes a random sequence of emotional decisions. Most traders believe discipline means controlling themselves in the moment. But self-control is fragile when fear is active. Fear does not ask for permission. It overrides logic. When traders feel fear, they rationalize their undisciplined actions. They convince themselves they are being cautious, flexible, or adaptive. In reality, they are reacting, and reaction is the enemy of consistency. A good strategy includes losing trades by design. Losses are not a flaw, they are a requirement. Yet undisciplined traders interpret losses as feedback about themselves. A loss becomes personal. It triggers self-doubt, frustration, and the need to recover emotionally. Once trading becomes a way to repair internal discomfort, discipline disappears. The trader is no longer executing a system, they are trying to feel better. Undisciplined traders often blame the strategy when results deteriorate. They say the market has changed, the edge is gone, or conditions are different. But most of the time, what has changed is their behavior. After a few losses, they hesitate. After a few wins, they overtrade. After drawdowns, they search for confirmation. None of these behaviors are part of the original strategy. Yet each one alters outcomes dramatically. A good strategy depends on neutrality. It assumes the trader will take every valid setup without emotional preference. Undisciplined traders cannot maintain neutrality because they are outcome-focused. They evaluate the quality of a trade based on whether it wins or loses instead of whether it was executed correctly. This mindset guarantees inconsistency. When wins validate behavior and losses punish it, discipline collapses. Fear of losing money is the primary driver of undisciplined behavior. This fear does not come from risk itself, but from the belief that losing is unacceptable. When a trader believes losses should not happen, they will unconsciously try to avoid them. They exit early, they tighten stops, they skip trades. Ironically, these actions increase losses over time by destroying the statistical edge. Another form of undiscipline is the need to be right. Good strategies do not require correctness on every trade. They require acceptance of being wrong frequently. Undisciplined traders cannot tolerate being wrong. They hold losing positions hoping the market will come back. They refuse to exit because exiting confirms they were wrong. This behavior transforms manageable losses into large ones, skewing the risk profile of the strategy. Overconfide. NCE also creates undisciplined execution. After a series of wins, traders feel invincible. They increase size, take marginal setups, or ignore risk limits. They believe the strategy is working because of their skill rather than because of probability. When the inevitable losing streak arrives, the damage is amplified. The strategy gets blamed, but the real issue was behavior. Good strategies are fragile in the hands of undisciplined traders, not because the strategies are weak, but because they require consistency to survive. Discipline is what protects a strategy from emotional contamination. Without it, the trader introduces randomness where structure was intended. Undisciplined traders also suffer from selective memory. They remember the trades they missed that would have worked and forget the ones that would have lost. This reinforces the belief that discipline is limiting rather than liberating. They believe flexibility is superior to structure. In reality, flexibility without emotional mastery is just chaos. A good strategy produces its edge over a large sample size. Undisciplined traders rarely reach that sample size. They change rules too quickly. They optimize after short-term losses. They abandon systems before probability has time to play out. This impatience ensures long-term failure regardless of the strategy's quality. Discipline requires acceptance of uncertainty. Without acceptance, the trader constantly seeks certainty through analysis, indicators, or confirmation. This search delays execution and increases anxiety. Good strategies do not eliminate uncertainty, they operate within it. Undisciplined traders cannot tolerate this reality, so they sabotage execution in search of emotional safety. When discipline is absent, risk management collapses. Position sizes fluctuate based on confidence rather than rules. Stops are moved to avoid being hit. Loss limits are ignored to avoid admitting defeat. These behaviors transform small, controlled losses into large, uncontrolled ones. No strategy can survive that environment. Undisciplined traders often confuse effort with effectiveness. They believe more thinking, more watching, and more tweaking will improve results. But thinking does not replace discipline. In fact, excessive thinking often increases emotional attachment. Good strategies require simple execution, not constant evaluation. The most damaging undisciplined behavior is inconsistency. Inconsistency makes results unpredictable, which increases emotional stress. Increased stress leads to more undisciplined behavior. This cycle continues until the trader either quits or resets with a new strategy, repeating the same pattern again. A disciplined trader accepts responsibility for execution, not outcomes. An undisciplined trader seeks relief from discomfort. This difference alone determines whether a good strategy remains profitable or becomes a losing one. Good strategies do not fail traders. Traders fail strategies. The market rewards those who can execute without emotional interference. Discipline is not an accessory to a strategy. It is the strategy. Without it, even the best designed systems will collapse under the weight of fear, hope, and the need to be right. Discipline is psychological alignment, not willpower, because willpower implies resistance, and resistance only exists when there is internal conflict. In trading, internal conflict is the true enemy. When a trader must force themselves to follow rules, it means part of them does not believe in those rules. That disbelief creates tension, and tension always leaks into behavior. True discipline emerges naturally when beliefs, expectations, and actions are aligned with the realities of the market. Most traders believe discipline is about being strong in the moment, about overriding impulses, controlling emotions, and pushing through fear. This belief guarantees exhaustion and inconsistency. Willpower is finite. It breaks down under stress, especially in an environment as uncertain as the market. Psychological alignment, on the other hand, requires no force. When a trader is aligned, there is nothing to fight. Execution becomes automatic because it makes sense internally. Misalignment begins with unrealistic expectations. Traders expect certainty in an environment that offers none. They expect strategies to work quickly, losses to be minimal, and outcomes to confirm their intelligence. These expectations clash with reality. The mark ET produces randomness, drawdowns, and frequent losses. When reality contradicts expectations, emotional pain arises. That pain is what traders try to suppress with willpower, but suppression never lasts. Alignment occurs when a trader fully accepts how the market actually behaves. Acceptance does not mean resignation. It means understanding. Understanding that any trade can lose. Understanding that outcomes are independent. Understanding that probability unfolds over time, not in single events. When these truths are integrated into belief systems, fear loses its foundation. A psychologically aligned trader does not need discipline to take a loss. Losses are expected. They do not need discipline to follow position sizing rules. Risk is already accepted before the trade is placed. They do not need discipline to wait for setups. Patience is no longer uncomfortable because there is no urgency to be right or validated. Behavior flows from belief. Willpower-based discipline fails because it treats symptoms instead of causes. The symptom is impulsive behavior. The cause is fear and the beliefs that create it. A trader may succeed temporarily by forcing themselves to follow rules, but under pressure, after losses, during drawdowns, or when confidence is shaken, willpower collapses. Psychological alignment does not collapse because it is stable. Alignment requires redefining what success means. Most traders define success by profit. This definition guarantees emotional volatility. Profits fluctuate, and when they do, self-worth fluctuates with them. A psychologically aligned trader defines success as flawless execution. Execution is controllable. When success is defined by execution, emotions stabilize. Stable emotions produce consistent behavior. Another source of misalignment is the need to be right. The market does not reward correctness, it rewards consistency. When traders tie identity to being right, they resist exits, rationalize losses, and overanalyze entries. This resistance creates internal conflict. Alignment requires letting go of the need to be right and replacing it with the need to follow process. Psychological alignment also means aligning with probability instead of prediction. Prediction invites attachment. Attachment creates fear. Probability requires neutrality. Neutrality allows discipline to emerge without effort. When a trader truly believes that any outcome is acceptable within their risk parameters, there is no emotional reason to interfere. Many traders try to build discipline by adding more rules. More rules increase complexity and pressure. Alignment simplifies behavior. It reduces decisions. It clarifies purpose. A trader who knows exactly what their job is and what it is not does not struggle to act. Fear of missing out is another expression of misalignment. It comes from the belief that opportunities are rare. In reality, markets offer endless opportunities. When a trader believes this, waiting becomes easy. There is no urgency, no chase, no impulsive entry. Discipline becomes patience by default. Alignment also involves trust, trust in the system and trust in oneself. Self-trust is built by doing what you said you would do, regardless of outcomes. Each act of aligned execution strengthens this trust. Over time, discipline stops being a goal and becomes an identity. Psychological alignment removes emotional bargaining. Undisciplined traders constantly negotiate with the market and with themselves. They ask, what if? They look for exceptions. They bend rules. Aligned traders do not negotiate. The decision has already been made in advance. This removes hesitation and regret. When alignment is present, losses do not trigger behavioral changes. Wins do not create overconfidence. The trader remains centered. This emotional stability is the real edge. It allows the trader to stay in the game long enough for probability to work. Discipline built on willpower is fragile because it depends on mood, confidence, and recent results. Discipline built on alignment is durable because it is belief-driven. Beliefs do not fluctuate trade to trade. Alignment also requires understanding personal limits. Traders who over-leverage are not undisciplined. They are misaligned. Their risk exceeds their emotional capacity. No amount of willpower can compensate for that. Proper alignment adjusts risk to a level where fear is manageable or absent. The moment a trader stops trying to control emotions and starts understanding them, alignment begins. Emotions are not enemies. They are signals of misaligned beliefs. When beliefs change, emotions change automatically. A psychologically aligned trader does not feel disciplined. They feel clear. They feel calm. They feel certain about what they can and cannot control. That clarity eliminates the struggle most traders mistake for discipline. The market does not require heroic effort. It requires internal harmony. When beliefs, expectations, and actions point in the same direction, discipline becomes the natural expression of who the trader is. In the end, discipline is not something you do. It is something you become. And that transformation does not come from trying harder, but from aligning your mind with the truth of how the market works. Discipline is not about forcing yourself to behave correctly in the heat of the moment. It is the natural outcome of psychological alignment with uncertainty, risk, and probability. When beliefs match reality, execution becomes effortless, emotions lose their power, and consistency emerges without struggle. Traders fail not because they lack strength, but because they resist how the market truly works. Align the mind first, and discipline follows automatically. That alignment, not willpower, is what allows traders to execute calmly, think clearly, and remain consistent long enough for probability to deliver results.